as Prakash is mentioning, there is a growth in wealth across this thing, and the industry is going to start looking more internally than externally for its sources of capital. Like Deepak, they are primarily a family office that's funded with internal capital, and I think that's probably going to be the way that things move forward. Is that the pie has to grow from within.
And we're not talking about the two pies. So coming back to Deepak, our discussion just before the session here, you said something very interesting about VC investing as an asset class. And a general question, a layman's question. You usually see venture capitalists as someone who not only provides capital but also expertise in hand-holding the venture. So do you think for a general investor, this could be an asset class to look out for?
Yeah,
or is this like a myth? I mean, are these two things different?
You mean providing capital and support?
Yeah. So that's generally how VC investing is perceived.
Yeah, so it depends on whom you're looking at. If you're looking at an investor, I think we'll go with what Prakash mentioned. It's purely about the math. He really doesn't give a damn how you made the money as long as it's legal and legit, right? But when you're a startup and you're seeking money, that's when this starts really playing on you. Because if you have, looking at how the markets have been, or how VC investing has been the past 24 months, when you've got a lot of money lying around, a lot of VC money lying around, how do you as a founder make a choice? So then it's the promise of who you think can give you more support. While that is the assumed promise every time, if you're a founder, you'd be smart to actually look at the portfolios of all the investors and assume that the only help you'll get is probably a call to the other founder saying, look, we've invested in this guy, why don't you go meet him and see if you can work together. And the rest, all the legwork has to be done by you. So if you like the portfolio, it's probably a better place to go with that investor than somebody who's high on promise and it's likely to end up as low on commitment.
Sure.
Because everybody's busy, so you got to make your way, and therefore you are looking for what is that hunting pool I can go into and basically build my own network and cross-sell and do things like that. But that's about that. You should be realistic about how much an investor can push and make you successful. Sure. Of course, there is the element that when it comes to Series B or a Series A and subsequent rounds and how much money they put, how much they're forthcoming to continue participating. But the reality is, if you're expecting things other than financial support, you have to do your groundwork and homework better than just taking anybody's word for it.
Sure. So do you also manage traditional investments in this family?
Not out of Aarin, but if you look at the entire Manipal story, we have the hospitals business, we have a stem cells business, we have a student infrastructure business, we have an education services business, and those generate regular cash flows for Ranjan. And that's a sign of that's a different side of things, and I use the dividends pretty much like Premji invests.
So coming back to Prakash, real estate market demand has been a bit soft as we discussed. And let me also give you a disclaimer. The audience will be majorly watching this telecast of this session is going to be the investors. We usually put the sessions on our YouTube channel and kind of send it across to all our investors whom we cover during our financial literacy drives, as well as the professionals. So a question: do you think the private equity role, the role of the alternative investment funds is basically coming against the investor interest right now because the prices are not going down even if the demand is soft?
No, I don't think, to whether the prices are going down or up has really anything to do with private equity money. So there's no question that the market is slow, and why it is slow, you can go through different reasons for it, but predominantly I'm saying obviously there is a price and demand mismatch. So where there is demand, there is no product, and where there is supply, there is a mismatch in the supply and probably the demand. Now, the real estate business in India is very complex, and real estate is the only business where your customer thinks that the developer has a moral obligation that every customer makes money. So if a developer decides to reduce the rate, the existing guys will come and kill him. No other asset class this works. You buy, invest in equities, tomorrow the stock crashes. Stock crashes. I was looking at, I just happened to look at Eros International, and you've seen what has happened to that stock. But nobody is going and saying, okay, let me go. Now obviously because they are listed in US, there are class action lawsuits, this, that, something, all that stuff will happen. But an average investor cannot go and file an FIR against Kishore Lula because he cheated them. But real estate, all kinds of crazy stuff happens. So it's a very complex business, especially in India. And the input costs, the taxation, pretty much, ties the developer's hands in terms of, what you can sell at. So I don't think private equity has anything to do with it. Private equity money doesn't come cheap. It is there. Investor has to give the return. Whatever it is, it's capital available for somebody who needs it if they are willing to pay the high return that private equity comes with.
Sure. So another question. Alternative investment funds, as we discussed during the day, SEBI has come up with this very clear mandate that minimum investment required is 1 CR. So this question I would like to ask the panel. According to them, what should be the ideal, space in an HNI's portfolio for alternative investment funds? Radha?
I'm not really an expert on funds and the structuring of it, but really, I think many of the panelists hit on it before, which is that you really need to look at the asset class and look at the characteristics, right? The characteristics are basically, limited price discovery, liquidity issues, but healthy returns over a long term, okay? So it's very difficult to characterize who as a investor is suitable for that kind of an asset class. You could have somebody that has 50 lakhs to invest and has no kids and is single, and they would be fine with putting money into something that over the long run yields them better returns, right? So, but by the same token, I also understand that SEBI has to make a call somewhere or the other. They have to draw some kind of a line in the sand and say this is the limit at which you need people to have for them to get into it. And the fact that due diligence, because of all these characteristics, due diligence is inherently a much more difficult process. So you don't want to be lowering the thresholds, fine, but do you really want an investor with 5 lakhs of rupees to invest, going through the due diligence process and making an investment, or he's just going to throw a dart and say, here's my fund? That's much more likely, sure. Right? So from that perspective, somewhere in between, I don't know whether there's a magic number out there, whether 1 CR is that magic number or not. It really depends on the investor characteristics and on this thing. But I don't think that that's really that big of a debate. I think that's a secondary debate. Once you set it at some point and see, I mean, is that really, the real critical question is that really holding the capital back? I mean, if tomorrow they were to reduce it from 1 CR to 50 lakhs, does that mean that there would be tons more capital flowing into this AI space? I'm not really sure. I don't think so.
Sure. Right. So, Bill, a question to you. I mean, how do you, how is it like? How is it shaping up this this space, alternate space? I mean, how evolved is it in the US, and which are the other regions where you think you find the customers really very educated about this?
Well, yeah, you have to start somewhere, and if there's a limit, I think that's always dangerous, because say for instance SEBI, the industry says no more than 1% of the portfolio. I would say, why bother? What is 1% going to do in the first place? It's not going to help you on the upside, it's not going to give you a lot of protection on the downside either. So I think that education's got to be the leading edge to this. Again, helping the investor and maybe the intermediary, it's a financial planner or an investment advisor, understanding what these tools are and how they can impact the portfolio. And then the attention's got to be paid to the liability side of the balance sheet. That's where it's got to start. And what is the risk tolerance of the person on the other side? And then the bottom line is going to be what the bottom line is going to be. But I do understand that if these vehicles are new, there can be issues in terms of how they're distributed. Unlike maybe a very traditional equity fund, what's on the label is not necessarily what goes on inside the box, and you very much could be thinking that you're getting an uncorrelated source of beta, but you're getting a leveraged version of the same things in your portfolio in the first place. So understanding what goes on inside that box is, I think, so much more important than setting a percent in the portfolio. Sure. And I think just having a cautious regulator is good, but the regulator, and I think SEBI is very good from what I know, but the regulator's got to be predictable, and I've never seen a market where the regulator has led the industry to the promised land. I think oftentimes they overreach and it just stifles growth. So I think that you've got to have this challenge and trade-off, and I think eventually this market will find the right answer.
Sure. So we have a lot of this, sorry.
I think that 1 crore limit is important. Because, you know, whichever way you cut it, some of these alternative investments are clearly a little bit higher risk, not because of any other reason, because they are completely illiquid. And, you know, having this concept of being only allowing what they call as accredited investors to invest is not something new. It's all over the world. So you go try to sell naked puts, they won't allow you, because people don't understand the, you know, the downside risk and stuff like that. So I know this used to be 25 lakhs at some point, and you know, investors, I mean, for a lack of a better word, when things are going great, everybody is happy. When things go bad, you know, investors can act very dumb. So I didn't know. I read, you know, 24% IRR. So where is my 24%? I mean, ICICI got sued. There's no question in my mind, ICICI never guaranteed they'll make 24%. But it's easy for a bunch of investors to get together and act dumb like, oh no, we know, you told me this, told me that. So I think the fact that they've increased the threshold is harder for a guy who's committing 1 crore to say, I didn't know, I didn't read.
Correct. So there are also a lot of these startup aggregator platforms which are coming up, like Let's Venture, Greg's, Startup Village, etc. What are your views on that? Because I believe the threshold, the investment, minimum investment is much lesser. I think it starts at 5 lakhs or something. So your views on this?
I mean, from my perspective at least, you know, there is always a time in any space where there is like a herd mentality. And today that is happening in the e-commerce space. You know, a few years ago it happened somewhere else. So people are just blindly putting some money, which is actually the highest risk money. That's the highest risk game, putting money in a startup. So I always tell people, you know, when you go to a casino and you put money in a slot machine, if you win, there is a bell ringing, light flicking. If you lose, nothing happens, clunk. So you sit there and all you see is bells and lights and you think everybody is winning except you. So startup game is like that. All you read is Flipkart and Ola and this and that, and you forget about the 50,000 other companies that went in there and that never made it to whatever series A, B, C, whatever you call it. So for people to just put 5 lakhs, 10 lakhs, I mean, people are putting 25 lakhs, 30 lakhs on a startup business plan, which at least on the face of it has zero probability of success. But you tell them the same 25 lakhs you go put somewhere else, they'll say no, 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 equity, mutual fund, this, that, they have enough data to say, but here there is no data, so they think this is the next whatever.
This I can vouch for a fact that I see a lot many names on LinkedIn flashing angel investor as a title. It's a new buzzword. I mean, people like calling themselves angel investor if they're investing a very small amount. So that brings me to you, Deepak. I mean, you of course invest in multiple sectors, and I'm sure you would have invested across multiple companies. What have you seen? What are the challenges that you've seen while dealing with the startups and these new ideas, in terms of taking them from first check, as you said, to Series B or exits?
So I'm going to first pick up on what Prakash said. Just 30 seconds back, you were talking about a sophisticated investor, which a lot of the inspiration draws from Rule 144A of AISI about accredited investor, and now you've allowed a backdoor for somebody to put 5 lakhs. So if we were all at the same slot machines and the bells were ringing, everybody would make money. Now the reality is, if you want to be an angel investor, the first thing you got to understand is, look at any PE or VC. They don't have a risk concentration. They don't go all in on one company. So if you want to sit there and you have only 5 lakhs, please call somebody, a mutual fund advisor or something, and put something in a safe asset. Don't try and fool around with this. If you want to have real fun taking these kind of bets, seriously go and gamble, because it will take you some time to blow up the 5 lakhs and you'd have a lot of fun. Because in some place you might actually get back money and you go, and if nothing else, like, you spend 300 bucks, watch a movie 2 hours, you get 5 lakhs, it'll probably give you 40 hours of entertainment, you'll come back feeling happy. Absolutely, they give you free booze, I mean, look at that. So it just doesn't get better than that. So it is a sophisticated activity. It is not to be taken casually. You are not going to, the probability of you finding the next Google and making 1000x on your 5 lakhs is extremely low. Yeah, so like I said, the casino is probably a better place to go. So when you look at any PE, VC, or whether, I'm sure it applies as much to real estate, is that you take a portfolio approach, and that's very vital, and you don't overstretch on anything unless you're very based on the kind of track record that's being developed in the company you've invested in, whether you want to double down on an investment or you have to take that even tougher call is to cut it loose and let the runt in the litter die. So it's as simple as that. Therefore, when you look at the investors, please look at the investment almost always, without exception, as a portfolio and bets. Logic would be that you please try and find some guys with a good track record, or like you said, no track record is better than a bad track record, and give them the money and hope that things will look good at the end of 8 or 10 years. Be patient and follow up with your GPs and see how they're looking at companies and how they're managing them. That's very important. Otherwise, to an extent, the first check is, to a large extent, a small check, and it runs the risk that out of say 5, I'd probably get 2 or 1 who'd get to a Series A. And then the Series A goes to B, because this is, like I tell people, it's like trying to cross the Sahara with a good vehicle, but half a tank of gas, assuming that you will get refueling as you go by. The best of vehicles can fail. The worst of vehicles can get funding and go much further before they drop dead, and some of the funniest companies actually manage to give you fabulous returns because there's somebody out to buy them. So, like Mark Anderson himself tweets, the amount of data you have in the startup universe does not ensure your likelihood of success. There is a huge element of luck, and there is a huge element of entrepreneur pluck that really makes companies succeed.
Sure. So we slightly running short of time, so I'll quickly maybe ask a common question to the group here and then open it up to the audience if they have to ask any questions. Starting with you, traditional or alternatives? What do you recommend to an educated? I'm asking you, I mean, in Indian perspective, Indian context. I think I'll ask. I have a separate question for Bill though.
Yeah. Well, we've always put our money for the last 10 years in the alternatives basket. So it is firmly in the alternatives basket. So that's our whole company is built around alternatives and nothing else. So
that's something you recommend to evolved Indian.
Yeah, but we are not just a manager. We are an owner investor. We have funds of our own at play, and we have this is a full-time business that requires you to be on the ground doing due diligence before continuing to follow up. So we have different models that we work with portfolio companies on, and none of those models are every one of them is due diligence intensive, if you will, and follow up and operational aspects intensive in some cases. So if you are willing to do that homework, then absolutely, alternatives is a fantastic rewarding area to be in.
Sure. Any parting lines?
I mean, VC, I definitely don't recommend that you try and build your wealth only on VC. You're a brave guy. So.
Sure.
I mean, it has to be both, right? It cannot be either or. And even in alternative, based on your risk appetite, you can play the VC game, which is high risk, or you can do structured debt, which is, high yield returns, because eventually, in the long run, I think the multiple counts rather than trying to find that 100x return. I mean, if Warren Buffett if he's the most successful investor, I mean, over a very long period of time, he's returned about 18%, which is unbelievable if you can do that for 50 years. If you do it for 10 years, it's unbelievable. And 18% doesn't sound very exciting, but in the alternative debt space, you can make 18% without a whole lot of headache. So if you can make 18% for 10 years, then you've done pretty much 6x. But the key is to just stick with it. The problem here is, we keep trying to move in and out. So that's where the problem is.
Sure. So last question to you, Bill. Sitting in Mumbai or Bangalore, and if you happen to be a reader of New Economic Times, you tend to believe that the world is talking about India and startups and companies because there's so much of news all around us. From where you operate out of, how do you see? I mean, how do you see India, and which are the other major regions you feel which are doing? I mean, maybe creating an equal buzz right now in terms of the startup or alternative investment space?
Well, yeah, I certainly think Bangalore falls into that category. It's somebody said it today in the audience. It's the Silicon Valley of India, and I think there's a lot of innovation that comes out of these areas, and it's not necessarily just as an alternative product. Hopefully, good ideas that can aid to a stronger economy are part of it as well too. So I think it's great. This is the first time I've been to Bangalore, and it's been very good exposure. It's not even 24 hours on the ground, unfortunately, but I think that kind of innovation is great. I think when you look at it from an investor standpoint, I really agree with the rest of the panel in that slow and steady might be a little bit boring, but it wins the race, and it's almost like the tide coming in and out, and it's not going to kill you. A tsunami will, and if you're going to try to find that home run, it's fraught with danger. And there's a Warren Buffett quote that I'll maybe close with that I use oftentimes myself, where he says, "Risk comes from not knowing what you're doing." So oftentimes it's not the vehicle, it's the practitioner. So some of these equity investments and private equity investments and venture investments can be very, very good, but the average investor is not going to be able to sleuth out the opportunity from the dog, and that's better left to the professional. So I would say let's stick with the slow and steady, and if you could find a way of compounding at 6 or 8%, I personally would sign up for that for the rest of my life.
Thank you so much. I think that brings us to the close of the session. If quickly, if we have audience here have any questions for the panelists, we can take it. Yep.
Hi, my name is Devaki. I wanted to ask a question to Mr. Prakash. What according to you is alternative investments actually? Just wanted to understand that.
I think to me the term really is more of a financial term that is SEBI has attributed, and it basically represents, you put money in your bank, that is not alternative. You go buy a mutual fund, you could buy a stock in the listed stock exchange, these are all traditional investment options. Anything which is non-traditional, so for example, if you buy a home, that's an investment. You could buy it for investment, but it's not an alternative investment. But if you invest money in a fund and that fund is buying real estate, that makes it an alternative investment. And predominantly because your 1 crore in the fund may be invested in 25 assets. You don't know which assets, which one will exit when, this, that. So I think from a definition perspective, simple definition is anything that you don't understand is alternative.
Good one. So I just, to sum this up, just wanted to say that maybe, investing into startups can be a good idea on the alternative investment side.
No, investing anywhere is a good idea. Whether it's a good idea or not, you find out later. So when you first put in, clearly everything is a good idea. Nobody invests in anything, says this is a bad idea, let me go invest, right? But whether it turns out to be a good idea, whether it's a startup, whether it is a big company, small company, real estate, stock, mutual fund, people have lost money putting in a bank, banks have gone bankrupt, right? So.
Okay, thanks.
Yeah, we are talking about REITs for last about a year or so. How would that affect the real estate, PEs and those funds?
So once again, in India we tend to talk about stuff we think it is a bright idea, right? Because it's actually not a bright idea necessarily. It may be a bright idea, but not a new idea, right? In the whole world, lot of countries, REITs are a common product. Now, only thing the REITs will do, it will give commercial real estate people an exit. Today what happens is, if I'm a commercial developer, it's very difficult for me to exit the leased asset. My only exit is selling it to some HNI, some this, some that. I cannot list it. Where I can, so instead of finding one investor with $1 billion, I can find 1 billion investors with $1. So it really will give the public to participate in that asset class, which they cannot participate today, and B, give an exit to investors. And whether it actually improves the commercial real estate market, this, that, there still has to be underlying demand for commercial and stuff like that, and the REIT value really depends on the rental returns and things like that. So it is a good product to have for companies to be able to access.
I'd like to just add just a couple of sentences to that answer, which is, he's covered 90% or maybe 99% of it. The only thing I would say is that when you have REITs, so again, for an individual investor, it's now it's an asset class that's currently not available. So an individual investor today can't go and own office space, A-grade office space in MG Road. But with the REIT, with the commercial real estate folks exiting, it's going to free up a lot of capital that they will be using to finish up projects. So there is a flow down effect of that, and it opens up an asset class, new asset class, if you will, for retail investors. So you know, I think that's a good development. That's definitely a good development. Though, if inflation continues to come down, then we might see, you know, if there's too much of demand for these vehicles and this thing, we might see yield compression, which will lead then to, you know, higher commercial real estate values.
So I think
real estate market is complex in India. You mentioned taxation, then the input prices going up, all those things. And what about corruption? How much it is contributing?
Complexity.
Yeah. It is part of complexity.
Yeah. Part of the complexity.
Major part or minor part?
Yes. Yes.
What, major or minor?
I said yes.
Exactly, the answer to the question.
all right, so I think time for us to call it a day, and a lot of us Mumbaians have to rush back to the, thank you so much, audience. I would like to thank all our partners and speakers. Centrum, who's been the lead partner for all right since the beginning. Harmony Capital, the CAIA Association, as well as Reliance Alternative Investment Fund. So thank you so much. We look forward to do much more in this space rather than conducting events. And as I mentioned in the morning, the setting up of Indian Association of Alternative Investment Funds is just the first step in this direction. We plan to set up a really prestigious industry representative body, something on the lines of AIWMI in UK, and do a lot of work on education and advocacy and research in the alternative space. So look forward to keep connected with all of you all, and please do share your feedback and views on the event, and let's be in touch. Thank you so much.
Thank you.